For more on the data and talk about tomorrow's big jobs report, I want to bring in Brett Ryan, senior U.S. economist at Deutsche Bank. And I'll ask you the same question that I just asked Steve, which is Jay Powell sees these numbers, and of course we'll see what we get tomorrow, and thinks what?
Yeah, thank you for having me, Andrew. And Steve hit the nail on the head. He sees these numbers and he doesn't see the labor market as a source of upside inflation risk anymore. And that's reflected in unit labor costs. That's reflected in higher productivity. And the concern now, as he espoused to Jackson Hole, is downside risks to the labor market. And so the upside risks to inflation are kind of fading at this point. It's all about the labor market and making sure that they don't see further cooling in the labor market.
But is that a quarter point worth of juice you want to give it, or 50 basis points?
Let's see what tomorrow brings. Now, we expect 150 on headline payrolls, 140 on private, and the unemployment rate to round down to 4.2. Those numbers would speak to a 25 basis point move at the September meeting and not 50. In fact, the Fed's only really done 50 usually after surprise meetings when there is somewhat of a financial shock or more greater concerns.
So you think bad news then is good news? Good news? I mean, that's the other piece of this I think we're all trying to figure out. When we see the number tomorrow, how we're supposed to sort of read the bad news as good news.
Yeah.
Or good, you know what I'm saying?
At this point, bad news is bad news because you'd be concerned about a sharper labor market downturn that would weigh on consumer spending and potentially signal recession. So I think at this point, bad news is bad news, and we've seen reactions in asset prices to some recent weakness in labor data.
Walk us beyond the headline number in terms of the fine print. What are the other numbers that you'd focus on tomorrow morning?
So for us, we'll be looking at the household survey, and it's going to be that temporary layoff versus permanent layoff. So up to this point, basically the rise in the unemployment rate from 3.4 to 4.3 has been mostly re-entrants and new entrants. And that's sort of a labor supply story, right? That's sort of a labor supply story. If we see permanent layoffs begin to start to tick up, that's problematic. And that's indicating, as Steve talked about, that we're seeing a rise in layoffs. Jobless claims so far don't speak to that, as Steve noted. They're following the pattern from last year, but it's something that the Fed's going to be on the lookout for.
I got maybe a curveball for you. I don't know if you read the Wall Street Journal earlier this week. There was a fascinating piece about immigration and workers in America. I don't know if did you see this at all?
I've looked at it a lot.
Okay, and it was an interesting piece because it effectively seemed to suggest that, if you cut off immigration, even illegal immigration to some extent, that you could actually create productivity problems in this country. And I was curious what your reaction was to that.
So immigration, we need it. I leave it to policymakers to decide how that is. But yes, the dirty little secret here is that even illegal immigrants will pay into the Social Security system.
And I'm not suggesting we want illegal immigration per se, but it was just, I think when you read through the article, you sort of said to yourself, at least that's what it made me think.
Yes, and it's a positive contribution on net to the economy and to productivity. And so, we want to come up with policies that would, sort of, bring these people into the light, I would say, and bring them into the economy more fully. But yes, the contribution to the labor supply story is one of the reasons why the Fed's not hiking anymore right now.